Everyone's talking about the next big crash. US stocks are at all-time highs, and you've probably wondered, is it time to pull out before the bubble bursts? The fear is real. With valuations soaring and volatility creeping in, it's getting harder to know where to put your money. You've seen it, the headlines, the warnings, the uncertainty. People are talking about the next crash, and no one wants to be the last one holding an overpriced stock when it all comes down. But while people are concerned with fear over what's happening here at home, Charlie Munger knew that the best opportunities often come when you look beyond the obvious markets. Right now, there's an undervalued market sitting on a massive potential, one that Munger was never afraid to invest in, even when others were. In today's video, I'm going to reveal why Munger would be buying big right now and where the opportunities for long-term gains are hiding. I will show you the top 5 stocks expected to double their valuation in a few years, in one of the most undervalued markets of its time. Let's kick things off with some Charlie Munger wisdom, because if there's anyone who knew how to spot an undervalued gem, it was him. Now, Charlie wasn't your typical investor chasing flashy stocks or the latest trends. No, he was all about long-term value investing. His mantra? Buy strong businesses when they're cheap, hold them for years, and let them do the heavy lifting. It's simple, but it's the kind of strategy that built him and Warren Buffett one of the most successful portfolios in history. And right now, this mantra applies to Chinese stocks. So how does that apply to China today? Well, Munger had a soft spot for Chinese companies. He was never shy about putting money into them. Companies like Alibaba and BYD were his top picks. Why? Because Munger was all about finding value where others saw risk. And China, with all its noise about political uncertainty and regulatory crackdowns, fit that bill perfectly. Here's the thing. Price is what you pay. Value is what you get. Munger loved to say that. And right now, the value in China's biggest companies is off the charts, even though their stock prices don't really reflect it. Companies like Alibaba are global giants in e-commerce and cloud computing, but they're trading at a discount because investors are spooked by short-term noise. If Munger were still with us today, do you think he'd be running scared? No way! He'd be doubling down. Munger wasn't just a fan of waiting for the market to calm down. He thrived in the moments of chaos. When stocks were crashing and investors were panicking, Munger saw it as the perfect time to jump in. He once said, if you're going to be a net buyer of stocks over time, who wouldn't want the stock market to go down? You get to buy at lower prices. That's Munger in a nutshell. Buy when others are fearful. And that's exactly what he did with Chinese companies. And here's another point. Munger always looked at the long game. He wasn't worried about where a stock would be in 6 months. He was looking at 10 or even 20 years down the road. And that's what you need to do with China. The fundamentals of these businesses are strong. Their markets are huge and the potential for growth is massive. The prices today? Well, that's just a bonus for long-term investors like you. Alright, so we've talked about how Charlie Munger was all about finding undervalued opportunities. Now let's zoom in on what's happening in China's stock market today, because this is where things get really interesting. So despite the recent market recovery, China's stock market is still looking, well, cheap. I know. When you hear about China, the headlines scream about slowing growth, government crackdowns, and political uncertainty. But here's the thing. China's companies are still raking in profits, and the stock prices haven't caught up. In fact, many experts, like those over at Fidelity, are saying that Chinese stocks have moved from extremely cheap to just less cheap. That's investment code for there's still room to grow. Here's where things get exciting for long-term investors like you. While the rest of the world is still focused on the short-term noise, there's an opportunity hiding in plain sight. Major Chinese companies, such as Alibaba, Tencent, and JD.com, are trading at prices that just don't match their potential. If you compare their earnings to their stock prices, you'll see that these companies are still undervalued relative to the global market. But let's be real for a second. Investing in China isn't a free lunch. There are risks, no doubt about it. The political landscape can shift quickly, and regulatory changes can hit hard. That's why it's so important to do your homework. This isn't a close your eyes and hope for the best situation. But if you're like Munger and can stomach some short-term uncertainty for long-term gains, this is the kind of market where you can find serious value. One more thing to keep in mind, China's government has been stepping in with economic stimulus measures. They're pushing for growth in tech, infrastructure, and clean energy, which means companies in these sectors have extra wind in their sails. Not only are these stocks super cheap right now, they're also in industries that the Chinese government is actively supporting. So what's the big takeaway here? China's stock market still has plenty of opportunities, especially if you know where to look and are ready to ride out the bumps along the way. It's all about timing and patience, and if you're in it for the long haul, this might be the moment you've been waiting for. Alright, now let's get into the good stuff. Talking about specific Chinese companies that could be your ticket to long-term growth. These aren't just any companies. I am talking about global powerhouses that are currently trading at prices way below their real value. So let's look into top 5 companies that you should watch if you're considering investing in China's future. You've probably heard of Alibaba, right? It's kind of like the Amazon of China, but even more diversified. Alibaba dominates e-commerce, cloud computing, and even has a hand in digital payments through Alipay. Now, despite its massive size and influence, Alibaba's stock has taken a hit due to regulatory pressure and concerns about China's overall economic growth. But here's the thing, Alibaba's fundamentals are rock solid. This company isn't going anywhere, and with China's government pushing to expand domestic consumption and boost its tech sector, Alibaba is perfectly positioned to benefit. Its cloud business, for example, is expected to be a major growth driver in the coming years, much like how Amazon Web Services has been for Amazon. So what's the potential here? Analysts are predicting that once the dust settles and China's economy gets back on track, Alibaba could see a huge bounce back in its stock price. There's talk of the stock doubling over the next few years, especially if the company continues expanding its cloud and e-commerce arms. If you believe in buying low and holding for the long term, this is one company that should definitely be on your radar. Next up, we've got Tencent. This is one of the biggest names in social media, gaming, and cloud services. If you've ever played League of Legends or used WeChat, you've already interacted with a Tencent product. Tencent's reach is huge, and it's got an incredibly diversified portfolio, which means that even when one part of the business faces challenges, the other parts keep on generating revenue. Now, like Alibaba, Tencent stock has taken a hit recently, partly because of the regulatory crackdowns on the gaming industry in China. But here's the thing, gaming isn't Tencent's only business. In fact, WeChat, China's super app, is used by over 1 billion people every single day. This is not just a messaging app, it's a platform for payments, shopping, and services. That gives Tencent a massive reach that's hard to compete with. Even though the gaming regulations may have scared off some investors, the company's cloud computing and fintech segments are expected to drive growth over the next few years. In the long run, Tencent is one of those companies that could bounce back stronger than ever, especially with the digital economy continuing to grow in China. Some analysts predict the stock could rise by 60% or more over the next few years. The next undervalued stock is JD.com, another e-commerce giant in China that's often compared to Alibaba. But here's the big difference. JD.com owns its entire logistics network. That's a huge deal because it gives JD more control over its supply chain, which is critical during tough economic times. JD has built an incredibly efficient e-commerce platform, and even though its stock has faced challenges recently, its logistics and supply chain dominance make it a long-term winner. Think about it. JD is a company that can deliver products across China faster than almost anyone else. That's a major advantage, especially in a market that is as vast as China. With China's government pushing for more domestic consumption and digital commerce, JD.com is perfectly positioned for serious growth over the next decade. Analysts are predicting that JD could see a 50% to 70% stock growth in the coming years, as its logistics businesses continue to expand. So if you're thinking about investing in e-commerce, JD is definitely a company worth considering. Next on my list is Baidu, often referred to as the Google of China. Baidu is best known for its search engine, but that's only part of the story. The real potential here lies in Baidu's focus on AI and autonomous driving technology. Baidu has been pouring resources into AI research, and that's starting to pay off in a big way. Baidu's Apollo platform for autonomous driving is one of the leading programs in China. And as the world moves towards more self-driving cars and smart cities, Baidu is going to be a key player. Their work in AI isn't just limited to cars. They're developing cloud-based AI services that can be used across multiple industries. Now, Baidu stock has been beaten down, and that's because the market hasn't fully realized the potential of its AI technology yet. This is a classic long-term play where you buy in now and wait for the company's innovation to drive future growth. It is on track to doubling its stock price over the next 5 to 7 years as AI becomes an even bigger part of its business. Lastly, let's talk about BYD, China's electric vehicle giant. If you're thinking Tesla has cornered the EV market, think again. BYD is giving them a serious run for their money. In fact, Warren Buffett's Berkshire Hathaway owns a chunk of BYD, and that alone should tell you something about its potential. BYD isn't just about making electric cars. They're also heavily involved in batteries, solar power, and even electric buses. With China also pushing towards green energy and reducing its reliance on fossil fuels, BYD is going to play a huge role in that transition. Here's why BYD is such a smart investment. The demand for electric vehicles is only going to grow, not just in China, but around the world. As one of the leaders in the EV industry, BYD is set to capitalize on that growth. Plus, with the Chinese government pushing hard on environment initiatives, you've got a company that's in the right place at the right time. Analysts are predicting that BYD could see significant growth, with the stock potentially doubling in the next few years. Now let's talk about something really important: China's government and how it plays a massive role in shaping the opportunities we've been discussing. You see, when it comes to investing in China, you cannot ignore the government's influence. In fact, China's government is one of the biggest reasons why these undervalued companies might not stay undervalued for long. Here's the deal. China's economy has been through some really tough times recently, with slowing growth, regulatory crackdowns, and all sorts of headlines that make investors nervous. But the Chinese government isn't just sitting around waiting for things to fix themselves. They've been stepping in with economic stimulus packages designed to boost growth and keep the economy on track. For example, China has been pouring money into infrastructure projects, tech innovation, and clean energy, all sectors that are tied to the companies we've talked about, like Alibaba, Tencent, JD.com, Baidu, and BYD. The government is making a massive push to develop its tech sector and make China a global leader in AI, cloud computing, and green energy. And guess who stands to benefit from that? Yep, the very companies we've been discussing. And it's not just about throwing money at these industries. China's government has also been introducing regulatory reforms aimed at making its companies more competitive on the global stage. While some of these regulations have caused short-term pain for investors, like the crackdowns on tech and gaming, they're ultimately designed to create more sustainable long-term growth. And that's what makes China such a fascinating market right now. Of course, there are still risks. China's government is known for making sudden policy changes that can shake up the market. But if you're investing with a long-term mindset, as Charlie Munger would, you're not just betting on individual companies. You're betting on China's overall growth and its ability to shape the future of global industries like tech and clean energy. So what's the takeaway here? And the answer to the big question: is China still undervalued? Absolutely. The market may have recovered slightly, but there's still a lot of room for growth, especially in tech, cloud computing, AI, and electric vehicles. If you're willing to be patient, you could be looking at some serious gains over the next decade. Not sure about Chinese stocks and leaning towards US stocks, but worried about a market meltdown or hyperinflation? Click the video to learn what's happening in the US and what you should do.